The Nikkei down is 525.52 on Tuesday, or 3.002%. The Hang Seng is also down 235.91. In Shanghai, 0.93 on Tuesday. In New York, this is from on Monday, they were down 331.34. The NASDAQ, that's tech-laden, is down 74.24. The Merc, that's a commodities market out in the Midwest city of Chicago, 37.62. In San Pablo, on Monday also, they were down 995.41. And in Mexico, another petroleum producer, they were down 1,016.10, or 2.14%. So we are looking at a lot of that. Let's get to the commodities. We've already given these, but we'll snatch them anyway. Brent crude futures were down 96 cents at $52.15. The spot was down $2 at $54.10. West Texas Intermediate crude was down 78 cents at $49.07. Cocoa futures are down $11 there. Gold, this is the Forex on, let's get on Tuesday here, one of those indexes. It was up $19 there at $1,211. And let me see if we can scare anything else up out of here. Corn futures up $10.25. One of the big problems we've had in North America, particularly U.S., Canada, is the pricing of commodities. Commodity pricing, of course, obviously, is a futures market. It's a lot of risks involved there, a lot of speculative market, I should say, and the speculation is went in the wrong way. We need to get these commodity prices down. We've got petroleum down. That's a basic thing in America, especially in places like Los Angeles, California, where people drive every day. But we need to get some of these things down here, the price of basic things, so we can eliminate some of that. Because effectively what happens across the board, especially in an economy like the U.S., where 70% of the economic output is consumer-driven, as you free up discretionary spending, you will have more spending, but at a control rate, since basically your inflation you don't really have to worry about as much. At a certain point in time, probably 6 months out this summer. Now, understand that things don't exactly go along a continuum. This is more of a sort of a seesaw. There are reactions to market data, what happens in Europe, what happens in Asia, etc. In other words, external economies are global economies. But some of those reactions are not a long term. They are a few days, and you've seen some of those reactions there. In other words, things have changed. For instance, on the political side in the U.S., they will, as the Congress returns, that's the legislative body, they will take up the Keystone XL pipeline. That's to take this tar sand type of material across the U.S. down to Texas and on to tankers, or actually, onto the refineries in Texas. It's coming out of Canada. Alberta, Canada is where the thing starts, and it runs across the American Midwest state of Nebraska and several others, Wyoming, etc. But this is Canadian oil that's coming through this pipeline. The fracking stuff, let me get this straight, a lot of that is carried by rail, which is the railing company that has most of this is called the Burlington Northern Santa Fe. That one of the big owners is Berkshire Hathaway's Warren Buffett. So they're actually sending this stuff by rail car onto the refineries. So it is moving, and it comes from Canada and down through the pipeline. But the problem is right now is looking at the economic viability of this, as you have economies slowing down, and of course plenty of petrol out there to be bought at bargain basement prices. There is a glut. And OPEC being very wise, they've been in the oil racket for a long time. They know how to speed up their production, cause more glut. They can go at a 2-for-1, 3-for-1, 4-for-1 pricing and still compete with the rest of the producers. Same thing has happened with the Russian Federation. They are pushing a cheaper oil. In other words, say at one time they were getting $100 a barrel. Now they're getting $50 a barrel, but they're selling at 2-for-1, maybe 3-for-1. They have the spare production to do it. And Saudi Arabia, definitely quality oil is different there. Venezuela has some of the largest reserves. Quality of their crude is much better. So between the Saudis and, of course, you have other nations, Nigeria, Iran. So all these nations are moving in. So what that does to the American add-ons, they're pretty much out of business because it costs more to do the tar sand tap dance, as we'll call it. Not a very good economic term. But nonetheless, this is basically what is happening. Now, the markets were in the U.S. were focused on basically two things, what the Fed would do in terms of interest rates. They're less focused now in inflation. But inflation can be controlled, and you still have some slack in the economy out there. But at the same time, you look at the work participation rate in the mid-60s, you're not going to get 65 or 66 cents, 66% participation rate for the simple reason many people in their late 50s, early 60s are going into retirement. Thus, you don't have that tax-paying base. That's changing many, many things at how national policies are set because of where revenues are. So you have to come up with new ideas, just as in Europe they're now coming to quantitative easing. They are late coming to the table. China has been doing this for a number of years. The U.S. has done it. And what happened basically was that benefited the Wall Street banking sector primarily in the market and not Main Street. Now, one of the big problems is with the quote-unquote the stock market is that it's a very speculative, it's risk-oriented parts of it, and then we have something called the shadow economy where we bring in these various companies that sell annuities, all those sort of things, is not as well regulated. And that in itself causes some problems. So what we're seeing is a move to more regulation, and with the new Congress, it's a right-wing Congress, they will try to take off some of the regulations, but unfortunately for them, this will not work. They can go willy-nilly, or what they call laissez-faire, if they wish, but they are in a global economy. The U.S., however, is not as much globalized as some countries, but the other trading partners are moving along. And part of the problem here is not so much the basic economy, but your banking systems are integrated. So what the Chinese central bank does, the European central bank does, or the central bank in the UK, etc., has an impact on what the Federal Reserve in the U.S. and the central bank in Canada does. So those things, and plus also, when you look at the financial piece of the pie, that was the reason G.W. Bush put out TOP, because it was a larger slice of the American economy. Although consumer spending part is 70%, but when you start looking at the larger banks, they had about 80 to 90% of the banking activity. So that in itself can cause all kinds of problems, and we saw that with such things like financing and that a lot of retail stores use. So this is part of it for today. Nonetheless, this is Numbers Man on the 6th of January 2015. At around 7 o'clock, you'll get this at about 7:30 Eastern Standard Time on iHeart, on Spreaker, and any place else we can find to put it. Good day. On the 4th of January 2015, Numbers Man here with This Week in Economics. This is our weekly broadcast that we analyze the numbers behind the events that have occurred the previous week or shall occur the next week, and in some instances, as this particular episode, we'll be talking about Q4 or the fourth quarter, and in some instances prior to that, and try to weave a mosaic. Our goal here is not simply just to throw numbers at you, but to use modern day commentary from a variety of sources. It's not just some opinion that we hatched in a dark room somewhere on the East Coast or the West Coast or whatever coast perhaps we could be on. We'll start off here with Bloomberg, and we'll get factors in U.S. expand as that's at a more sustainable pace, and that is the key actually to expansion and the economy, that it should be on some sort of even and sustained platform. That it should, in other words, it should not be one day it's up, one day it's down, the seesaw model that we came up with. Nonetheless, manufacturing, I'll just read a little here, moderated at the end of last year to a more sustainable pace of growth as U.S. factors adjusted to weaker overseas markets and steady demand from domestic customers. The Institute of Supply Management Factory Index dropped to a 6-month low of 55.5, less than a forecast of 58.7. In November, that's a report from the Tempe, Arizona-based group, showed today in October ending a match 3-year high. Order growth slowed as some companies anticipated falling energy prices would allow them to receive goods and materials at lower cost. Cost is always the key factor, especially in the manufacturing sector. While other customers scaled back capital spending plans with global market cooling, production will probably hold up as employment gains and cheaper gasoline boost consumer spending. So we're seeing a shift in at least the U.S. economy back to the consumer from the export model. And of course the export model is about 20% of the U.S. economy. It's more of a pause than a refresh, than anything to worry about. That's from Michael Montgomery, a U.S. economy at IHS Global Insight in Lexington, Mass., who correctly forecasts the ISM reading. Manufacturing is going to keep expanding, but we lose some ground on exports. Thus, in the U.S., demand is growing. A separate index of manufacturers also fell in December, and we'll get to the market economic gauge here, decreased at an 11-month low. And we'll get to all those from the market people. We have a number of them from a number of different places. Last year, SMIs figured greater than 50 indicated growth in the middle forecast from the Bloomberg survey. Stocks were a little changed, erasing earlier losses in utilities and energy companies offset a slide in small caps. That's the Standard & Poor's index fell less than 0.1% to 2,058.6. Closed there. 11 of the 18 industries surveyed by the Purchase Managers Group posted growth by printers, metal producers, and furniture makers. The people at Berkshire Hathaway, Warren Buffett and Company are in the furniture business. They have a big market there in Omaha. The IMS Group's new orders gauge declined to 57.3 in December, the weakest in 7 months. Such delays in orders are unlikely to last. That's from Joshua Shapiro. He's the chief economist at Myra Fornelli.